Hello everyone. So in the last sessions we had discussed about how US dollar has become the dominant currency worldwide. So there has been a part 1 and part 2. We had discussed about petrodollar recycling, how US dollar has become dominant, the deals with Saudi Arabia and other Middle Eastern countries, Kuwait, UAE. Then what is dollar index, US dollar index, and also about the various sanctions applied by USA for the SWIFT bans, the SWIFT network bans, etc., which impacted the economies of, say, Russia, uh, Iran, etc. So now, as we have discussed all this, now let us come to another interesting topic, which is how the value of currency is decided. Means if we say Indian rupees, 83 rupees equivalent of $1. So how we set that, and how the value of dollar is also appreciated, and how that concept works. So this is again another concept clearance session. So how the value of currency is decided. So let's get into it. So mainly there are three types of currency exchange rates. One is fixed exchange rate, another is floating exchange rate, and another is a combination of this fixed and floating, which is called mixed exchange rate. So as you see on my screen, there is a foreign exchange market for this. So foreign exchange forex market, currency market. So there are a lot of financial institutions involved in that. The exchange rates are mainly based on the demand and supply. Again, the simple concept of demand and supply. So if you have more demand for a currency, well, in that case, anything, if you have more demand, the price of that increases. So here in the case, it is say US dollar, you have more demand for that and lesser supply, means the rate will increase or the US dollar will appreciate in comparison to say INR. So there is lesser demand for INR, more demand for US dollar, and say India wants to buy more US dollar. So you are giving off Indian dollar and supplying Indian dollar and demand for US dollar. So the rate of US dollar increases. Don't worry, we'll further decode this in the session. So say, let us take an example here. So Bijoy, me, has got 10,000 rupees with me and I am in the market, in the currency market, say in the foreign exchange market. Now, there are three people, say Wilson, Amol and Imtaj. These three people have got $100 each. Say $100, $1 equal 100 rupees means in this case, so it's only an example. So $1 means 100 rupees means $1,000 is like 10,000 rupees. So $100 is 10,000 rupees. So Vijay has got 10,000 rupees, but there are three 10,000 rupees people. Like $100 means it is 10,000. So each, if I pay them 10,000 rupees, I will need 30,000 rupees, but I have got only 10,000 rupees. So what happens? And this dollar guys, this Wilson, Amol and Imtaj is desperate to get the INR because they have to invest something in India. Say they have to invest in stocks, or say they have to start a business in India for $100. So for that they will require INR. They cannot do it in dollar. So they have to convert it. So there is a demand for INR. There are three people having a higher demand versus Bijoy, which is a single person. So the demand of INR is more. The supply of US dollar is much. So the rate of US dollar to INR, so INR will appreciate because the demand is high. So this is how the market works. And if vice versa, normally the vice versa happens wherein US dollar is having a good demand. So that is why the US dollar is having a higher rate compared to the lower INR valuation. Now let us evaluate how the currency rates fluctuate and what all things, through some few examples, I'll try to tell you how the rates vary. So for an example, if India, as you know, is the is got lot of 90% of the crude oil is imported. So if there is an increase in crude oil price in the market, say it can be due to OPEC cutting their production, or it may be due to some uncertainty in due to geopolitical tensions or whatever. So because of that, say the crude oil price increases. So crude oil price increases. India being 90% exporter of importer of crude oil has to spend more dollar, because anyhow some exceptions are there. Say we are doing these days, we are doing trade in ruble and rupees with Russia for crude oil, but that is also just 25 to 30% of the total crude oil imports. Rest is from Saudi, US, etc. So based on that, they are still in US dollar, dealt in, the trades are dealt in US dollar. So if there is an increase in crude oil price, then there is more demand for US dollar, because crude oil is bought in US dollar. So again the US dollar appreciate with respect to Indian currency, INR. Another example is that if say India, because of the highest interest rate, because the RBI has been increasing the interest rate uh, quarter on quarter, so to arrest the inflation, etc. So because of this, the interest rate, the FD interest rates are higher. So this can make the foreign institutional investors or the foreigners attract and bring in money into the Indian market, put it in the fixed return assets, and if they are getting higher returns than say US market or other markets, so there will be demand for INR, because to invest in India you have to convert US dollar into INR. In that case, the INR appreciates in with respect to US dollar, because the demand is more for INR. Another case can be if the Indian bond market becomes attractive. So the bond yield increases, means the more returns, coupon rates for bonds. So foreign institutional investors can come and invest here. So again, appreciation in INR. Another is stock market. So you can see FII is buying, FII is selling. You can foreign institutional investors FII. So you are hearing this day and day out. So if you see more currency comes in, they are converting US dollar into INR. So again, demand for INR demand increases. Dollar supply is there, so dollar depreciates or falls in rate in comparison to INR. Another way by which the US dollar can depreciate in with respect to Indian dollar, or Indian dollar appreciates with respect to US dollar, is that the government or the central bank is able to bring in suitable monetary policy wherein they are controlling the inflation. So inflation means lesser spending. So lesser spending means uh, lesser imports. Lesser imports means lesser US dollar being spent, means the US dollar demand goes down with respect to INR. Again, appreciation of INR. Another example is uh, if we increase our productivity, means if we increase the GDP, if we increase the exports. So if we increase the exports with respect to the imports, then also we are giving out things. So the we are exporting means somebody is importing that to their country. So INR products are going there, so they have to buy in INR. So they have to convert say US dollar into INR or their local currency into INR. So again, demand for INR increases. So INR increases in value. Also, there can be various government policies. These days, we can see that. So Apple is coming here, Google is coming here. So various companies are coming here, and government is trying to creating various good government policies wherein it is easier for foreigners to come here and set up their manufacturing facility or sales facility or factories here, so that they will invest in India. So they have to buy a plot here, they have to buy machinery here, they have to pay the people here. So everything is in INR. So US dollar again gets converted to INR, means INR appreciates with respect to US dollar. So if you see factors like interest rate, inflation, economic performance, current account deficit, the physical deficit, etc., affects the currency exchange rate in forex market. So basically, the currency rate fluctuates based on the supply and demand, as I mentioned earlier. So basically, the currency fluctuation with respect to supply and demand, this is like categorized under floating exchange rate. Now talking about the fixed exchange rate. So fixed exchange rate, like currency of Saudi Arabia, say Riyal, Saudi Riyal, Kuwait dinar. So for Saudi, the currency is pegged to US dollar. So USD rate. So if there is a fixed USD rate, say some rate of US dollar, it is pegged to the Saudi Riyal, even the Kuwait dinar. So as you know, there is no much fluctuation in the US dollar. There is no much fluctuation in the Saudi or Kuwait as well, because they are directly pegged at a fixed rate to the US dollar. So Kuwait, if you see, the currency is pegged not just with dollar, but there is a bundle of currency. Say dollar is there, pound is there, yen is there, etc. Now you would be thinking that why not India also have a fixed exchange rate? So much advantages. So why are we not using that? But this doesn't work just like that. There are various factors of consideration for having a fixed exchange rate. So if you see a country having a fixed exchange rate, should have a good reserve of the items to which it is pegged. So in case of Saudi, it is US dollar. So it is pegged to US dollar. So they should have a strong, huge reserve of US dollar with them. So for Kuwait also, they should have good reserves of US dollar, pound, yen, etc. So they are actually big crude oil producers and then exporters. So they have got a good revenue, good economy, good productivity, good GDP. So based on this, they can have good reserves because anyhow they are selling crude and doing it in US dollar, as I mentioned earlier. So it is very easier for them to make a good reserve of US dollar. So this is easily achievable, unlike India, for these countries. Also, if you see the interest rates, say in Saudi, also cannot be much different from the pegged currency, which is US dollar. So if there is some interest rate in US, say, similar interest rate or somewhat similar interest rate also will be prevailing in Saudi as well. Also, if the world raises concerns of the currency, like the authenticity of the currency, is it really strong? Is your real economy really strong? So somebody will have to, the country will have to disprove it by showing the strength of the economy, by projecting that they are having huge reserves of US dollar, etc. So this is another issue. If our economy is very strong, provided you have good exports and have good reserve of foreign currency, gold, etc., then you can easily opt a fixed exchange rate for currency. But Kuwait and Saudi, as I mentioned, crude oil is helping them do this. India doesn't have that because 90% of the crude is in fact imported. So India has got majority floating rate only. But sometimes RBI or government intervenes and controls the currency rate by buying or selling US reserves or US dollar reserves in the open market. And this is only a rare cases. So then we can call it a mixed exchange rate. So majority is it is floating exchange rate only, but sometimes it is going for a rare cases of mixed exchange rates. This is how, in a gist, if you see the currency, the value of currency is set. So if we have a strong economy, very fundamentally strong economy, like I told in the last session, that a resilient economy, high productivity, high low unemployment rate, stable inflation, favorable economic conditions like robust GDP, increasing consumer confidence, then healthy corporate earnings for various companies, then the monetary policies, good monetary policies wherein interest rates are high, then there is huge cash flow or the money flow from foreign investors, then geopolitical stability, there is no much economics or political uh, uncertainties in the country, and also a good reserve of, say, in case of US, then US reserves is there with various countries worldwide. So such strong economical background if there is for the country, then it is fair chances that that currency can be made as a global currency. But if you see these days, many transactions are happening, especially with Russia, China, etc., in Chinese currency. But if you see again, uh, only very small portion of the total US dollar transactions, compared to US dollar transaction, it is only small percentage of Chinese currency being utilized. And also, if you see in China, there is a lot of uncertainties. There is government policies which is not that friendly for other nations, and the openness is also less. So such factors are very vital for deciding the international currency or the general trading currency to be opted as a dominant currency. So currently, US dollar has got its dominance, but maybe the various sanctions which it has been applying and taking undue advantage. So this may lead to other currencies like Chinese currency, Indian currency, etc., coming into relevance. That's like a wait and watch thing. So hope this session was useful for you. We'll come up with some other interesting topics in the coming sessions. Hope your investments are doing well. Say invested. Do your own due diligence before investing into various instruments available in the market. Hope you like this video. See you in the next video. Till then, happy investing.